Hello everyone, this is Bhavik Chokshi over here and I hope you guys are doing well. In today's video, we are going to discuss about CFA Level 1 derivatives, a one-shot quick revision for the entire subject in the best possible time. So, before we proceed, in case you kind of like this content, please do make sure you subscribe to this channel so that you get notifications for all further videos that you upload, and please do like the video if you find this content to be helpful. Okay. So, we'll start with CFA Level 1 derivatives. Derivatives over here is one of the topics which is quite introductory when it comes to Level 1. The weightage is around 5 to 8% and that translates into 9 to 14 MCQs into your afternoon session. Typically, derivatives, there are 10 readings and hence we can say anywhere between 1 maximum 2 MCQs will come from a particular reading, and hence relatively you can skim through this reading and kind of optimize it in terms of the best possible time. So that is what we will try to do. We will discuss everything, but at the same time focus on the overall understanding of all concepts so that you can quickly get through with the MCQs, and before you revise you have a very good understanding of this entire subject. So let us get started. First is understanding what is meant by derivative. So before we go to the actual features, a very simple example would be, let us say if I were to go to the exchange market and buy dollars immediately, that's a spot purchase where I have to pay, let us say, the rupees and get, let us say, the dollars. However, if I want to buy the dollars after 6 months, I don't know what the price would be after 6 months. So I enter into a contract called as a forward contract with, let us say, a counterparty, let's say a bank or a dealer, where I agree to buy the $1,000 on a predetermined date, let's say 6 months later, at a predetermined rate, let us say 80 rupees. This contract is an example of a derivative contract. Well, why? Well, this contract has 3 essential features of a derivative. First, it has to derive value from an underlying. Like this contract's value is determined from how the underlying, let's say the currency moves. Like for example, if the exchange rate becomes 90 or 95 and I have a contract to buy the dollars, for example, at 80, in which case this contract is valuable. That is, it gives me a benefit of buying an asset at 10 rupees cheaper as compared to 90, it can buy it at 80. So this contract becomes more and more valuable as, let us say, the rate increases if I have bought this derivative, and if, let us say, the rate decreases, it goes from 80 to, let's say, 70, in which case this contract results in a loss or an obligation. So the value of this contract is deriving from an underlying, let's say, currency. Well, there can be other underlyings as well, like there can be equity share, there can be bonds, there can be currencies, there can be interest rates, there can be any types of underlying where you want to kind of take a derivative position. Secondly, the settlement will not happen immediately, it will happen at a future date, let's say in our case 6 months later. And third, the amount paid initially is nil or insignificant. Like in a forward contract, you don't pay anything initially. In case of a future contract, we'll study that, we kind of pay the deposit or the margin, and in case of option, we pay a premium. But nevertheless, these are all quite small or insignificant as compared to the overall contract value. So these are the 3 essential features of a derivative in general. Now we'll discuss the types of derivatives in detail over the course. However, as a broad introduction, there are 4 main types of derivatives. Forwards, which is an over the counter, that is, there's no regulated or a central market. Over the counter, it is between the bank and the entity. Product, which is highly illiquid, the contract sizes over here can also be customized. However, if I want more liquidity, that is, I want these contracts to be tradable, in which case I will enter into a futures contract where I can go on into an exchange and there is a standardized contract to buy a set amount of dollars, let's say $100 on a set date, let's say on 30th September. So these are called as futures contract. Now the advantages of futures are that they are quite liquid. However, you cannot customize the future and you have to stick with the standard future size. Now in case of both forwards and futures, the drawback is that these are two-sided contracts, which means they can give you a gain, they can even make you suffer a loss, and hence is the third contract, which is called as an option contract, whereby you get a right but not an obligation to buy, called as a call option, and a right but not an obligation to sell, called as a put option. In which case, if, let us say, the rate, your strike price or exercise price is 80 and the rate becomes 90, you can exercise and buy the dollars at 80. However, if the rate becomes 70, you can let the option lapse. However, such a one-sided contract will only be available if, let us say, you are ready to pay an upfront initial non-refundable premium. So there are 2 parties over here. There's the option holder who has the option to exercise, whereas the option writer who is giving the option. Option writer enters into this contract because they get the premium. Option holder pays the premium. Option writer receives the premium. And lastly, there is something called as a swap, whereby 2 parties agree to exchange certain commitments. Like one person might have agreed agreed to borrow at fixed, one person might have agreed to borrow at floating. Later they might change their mind and they want to kind of swap their exposures, in which case they can enter into a fixed for floating swap, for example. We'll do that each of these in detail, but these are the four main products when it comes to derivatives. Now, when you look at derivatives, especially in case of a forward over here, there can be a buyer of a forward contract. Like if I want to buy the underlying, that is a dollar, that is buyer, also called as a long position. Whereas there can also be a seller where I want to sell the underlying, or also called as a short position. Now, when will these buyers make a profit? So if I'm buying the dollars, under the forward contract, I will make a profit if the rate of the dollar increases. My exercise price is 80 and the rate goes above 80, then there is a gain. However, if the rate falls, well, there is a loss. Buyer is kind of having a bullish position and hence they will make a profit if the underlying increases. So if the market price is greater than the forward price, then there will be a gain. Otherwise, there will be a loss. But a seller is kind of having a short position and hence they would gain if, let us say, the price of the asset falls. So if I've agreed to sell the dollars at 80, but the price becomes 75, then this is a benefit for me because I can sell it at 80 when the market price is 75 and get a 5 rupees gain. So if the market price is lower than the forward price, there would be a gain. Otherwise, there would be a loss over here. Okay. Now the settlement can be something called as a physical settlement, whereby we pay the entire 80 into $1,000, that is 80,000 rupees, and we get the $1,000. That is a physical or gross settlement, or it can also be a cash or a net settlement, which means we will settle by differences in prices. Like if the rate becomes 85, then rather than I paying 80,000, getting dollars, that is $1,000, then selling it in the market at 85, might as well I can do the deal directly by the differences in prices, that is 85 minus 80, that is 5 rupees per dollar into $1,000. So that will be a cash settlement. Second, there is the transfer of risk. Derivatives can help you in managing risk. In case of hedging contracts, that is the risk minimization contracts, it can help you reduce the risk. And in speculative contracts, where you want to kind of make profit by speculating, it can kind of increase your risk exposure. So over here, this is derivatives. Advantages of derivatives over the cash market. First of all, the cost at which you can enter into a position is much lower in derivatives as compared to the cash market, because if, for example, if you want to buy 10 lakh dollars worth of shares in the cash market, you have to pay 10 lakh dollars. However, in the derivatives market, you can take a position by entering into a futures where the position might be 10 lakhs. However, the margin might be much lesser and you might just have to deposit hardly, let's say, $15,000-$20,000 or let's say $50,000 for a 10 lakh dollar position. Now, that is something which is exposure at a relatively lower cost. The transaction cost will also be lower and it has relatively less impact when you look at over the market price, because it is not kind of directly the cash market transaction. So this we'll study. There is an entire chapter, I think reading number 68 or 9 if I'm not wrong, where you are looking at the advantages of derivatives for various participants. So we will discuss that over there. Common underlyings can be bond, can be the index like the S&P 500, can be currencies, equity, even interest rates like SOFR, for example, commodities, even credit. Like there will be credit default swaps where whether the borrower will default or not is taken. That can also be an underlying, and then there can be other items like weather, etc., which can also be underlying. So this is regarding the basic introduction to derivatives. Second is the markets in which derivatives trade can be exchange traded, like the futures and options, and over the counter like swaps and forwards, etc. Now the key differences between the over the counter and exchange traded products are: in exchange traded, the contracts are standardized, there are specified delivery dates, there are specified contract sizes. So there is standardized set of trading rules, centralized location like the National Stock Exchange. There is minimum counterparty risk because the clearinghouse of the exchange acts as a counterparty. It is relatively more liquid and more transparent. However, customization is a big advantage when it comes to the forward contract, where there is no single standardized central location, but there are various dealers, but they are ready to deal in the amount denomination that you kind of want. However, there is more counterparty risk, relatively less liquid and less transparent, has relatively more trading cost, which may be involved over here. There's a special over-the-counter case, especially of a swap contract, which created a lot of problems during the global financial crisis of 2008, and hence internationally it was agreed to have a centralized clearing party in case of swap. So there's a central clearing mandate which will result in a central counterparty which has to exist, like which swaps are largely over-the-counter products, and hence there's no party which can kind of guarantee the settlement. But as per the global mandate, we have said that most of the internationally accepted swaps in popular banks will need to have a central clearing mandate, and hence, like a swap execution facility, there would be a centralized authority which will be responsible for assuring clearance, and hence to that extent the counterparty risk is relatively reduced. Okay, so that takes care of the first topic. Next, you go to this second topic where you largely discuss about forward commitments, contingent claims, which include options, etc. And there are quite a few examples over here when you read the entire reading to explain you the mechanics of a forward, explain the mechanics of a future, how will the margin be looked at, swaps, options, etc. So these are quite basic. You can kind of review these examples. We have even included a few of these examples, but at this point, for the benefit of time, I'm not going to go into those basic ground level examples on how forwards, options or swaps are actually going to trade, but we will focus on the larger concepts. So over here, as we discussed earlier, when you look at a forward versus a future, a forward is an over the counter product where there is no centralized exchange, it is a customized contract, whereas a future is a exchange traded product where there is a centralized exchange or a location and there's standard sizes. In case of a forward, both the parties bear the counterparty risk because they are parties to the contract. However, in case of futures, there's a process called as novation where there's a clearing house of an exchange which breaks the contract into two parts. Like if you have ever dealt on any stock or futures market, if you actually put a trade, you want to buy, let us say 100 shares of Reliance, you put a trade. Well, you don't know who the seller is, but that is not logical because if there's a contract has to have two parties. If you don't know who the other party is, then how is the trade even valid? It is because the clearinghouse of the exchange has broken the trade into two parts. Between you and the exchange is one contract, and between the seller and the exchange is the second contract, which means you have a guarantee that whatever happens, the exchange will settle the contract, and the other party also has a guarantee that whatever happens, the exchange will settle the contract. Now, the exchange over here is undertaking what is called as a counterparty risk, and hence, in order to mitigate or manage the counterparty risk, the exchange takes something called as margin. Now, the margin over here is usually depending on what is the maximum loss that can be suffered in a single day, because practically futures settle on a daily basis using a process called as a mark to market settlement. Like if you have agreed to buy the shares at 100 rupees and at the end of the trading day the price becomes 102 rupees, that means you have gained 2 rupees. The exchange will hand over the 2 rupees to you. It will take the 2 rupees from the seller, hand over the 2 rupees to you. The next day the rate becomes from 102, it becomes 95. There's a 7 rupee loss. The exchange will recover the 7 rupee loss from you. It will hand over the 7 rupee gain to the counterparty, and hence this is a daily settlement. So the exchange, what it does is it takes a deposit, initial margin from you, which is typically based on the maximum. I mean, there's a concept of VAR, practically value at risk. At 99.9% VAR, most of the exchanges value at risk, they will take whatever is the deposit from both the parties, so that they can kind of meet, even if the other party meet the commitment, even if the other party kind of defaults. So that is called as the initial margin. Now the problem is initial margin is decided initially, and it is possible that as days pass, your margin account can get utilized because you might suffer certain losses, and hence there is a threshold which is given. Like usually if the initial margin is 100 rupees, then 70 or 80% of that, let's say around 75 rupees, will be the maintenance margin, which means that if there is a loss of 10 rupees, your margin will become 100 minus 10, that is 90. No problem, you can keep it as 90. There's a loss of another 5 rupees, it becomes 85. No problem, you can keep it as 85. Or then there is a loss of 30 rupees on the next day. 85 minus 30 comes to, for example, 55. And as a result, over here, your amount in the margin falls below your maintenance margin, which was, let us say, 75, in which case you will have to replenish, refill the entire margin, take it up to 100. And hence, there will be a margin call that will be there, where you will have to deposit 45 rupees again and take the margin account all the way up to 100. This is called as maintenance margin, and this entire mechanism of settling daily at the settlement price also is usually the average of the certain trades, closing trades over the last few minutes, depending on the exchange in which you are operating. However, whatever is the gain or loss, if there's a gain, will be given to you, if there's a loss, will be recovered from you on a daily basis. This process is called as a mark to market mechanism, and if due to this daily loss, if your margin falls below the maintenance margin, then you have to refill the entire amount to bring your margin account all the way up to the initial margin. This is done in case of futures, not in case of forward, because in futures there's a clearing house of the exchange which is kind of guaranteeing these trades, and as a result this exchange needs to take some deposit. Okay, so that is regarding forwards, futures, and let us say the margins. Then there is something called as swaps. In case of swap, most of the times the settlement that happens is a net settlement. Like for example, in case of an interest rate swap, I might have agreed to pay you a fixed rate of 10% in return for you paying me the secured overnight financing rate SOFR. In which case, let's say the secured overnight financing rate comes to, let us say, 6%. In which case I have to pay you 10, you have to pay me 6, and hence the net settlement at 4% on the notional principal I will have to pay you. Or if my rate is 10 and the SOFR becomes 15, then I have to pay you 10, you have to pay me 15, net 5% I will recover from you. This is usually in case of a swap. So in case of swap, the settlement will happen on a net basis depending on the terms and conditions which have been agreed. Now a special type of a swap would be, just a second before we discuss options, a special type of a swap would be a credit default swap, where the underlying is actually the credit of an underlying party. Like for example, there are two parties, there is a protection buyer and there is a seller, in which case if I have, let us say, a bond, I am worried that this bond of Reliance might default, so I might enter into a credit default swap with the writer. I might pay some premium and I might say that if this bond defaults, then you have to pay me money. For example, if there's a 100 rupee bond and there is some liquidity crisis and Reliance can pay me only 40 rupees, which means there's a loss of 60 rupees, credit loss, and that 60 rupees will have to be paid by the writer to the protection buyer. So this will help us in a credit default swap, help us kind of being protected from, let us say, credit risk events. So this is a credit default swap. Buyer pays a premium, seller kind of receives a premium. This is an example of a credit derivative where a bondholder is given a protection against a downgrade or a default by the borrower. A similar option can also be a credit spread option, where you are looking at the spread between the benchmark yield, like a government bond yield, and your bond's yield, and let's say you are guaranteeing a particular spread. Okay, then there are options. When you look at options, there is a call option which gives you a right to buy, a put option which gives you a right to sell. If you are an option holder, you are considered to be long the call, or if you are a put option holder, you are considered to be long the put. If you are an option writer, on the other hand, you are considered to be short the call or short the put, as the case may be. Remember, if there are two types of options. There is the American option which will settle at any time, at or before expiry, or a European option which will settle at expiry. An American option is very similar to an open-ended mutual fund which can be redeemed whenever the holder wants, whereas a European option is very similar to closed-ended mutual fund which can redeem only at maturity. However, if you want, you can buy and sell that on the exchange. Now, options come with attached premium. This is paid initially, upfront, non-refundable, paid by the holder to the writer. Again, when you may be asked to calculate payoffs. Payoffs depend on comparing the spot at expiry with the exercise price. Like in case of a call option, the holder of the option will exercise it if the spot at expiry is greater, let's say 85 as compared to the exercise price which is 80, in which case I have a right to buy at 85 an asset which is worth 80, and hence there will be a 5 rupees payoff minus whatever is the premium I might have paid will give me the net payoff. On the other hand, when you look at an option, a put option holder, you will exercise if long put will exercise if the price, spot price at expiry is less than the exercise price. Long story short, when you're looking at a call option, it's a right to buy. You love to buy at a cheaper price. So if the exercise price is cheaper, you will exercise a call option. A put option is a right to sell, and you love to sell at a higher price. And hence, if the exercise price is higher than the spot at expiry, you will like to exercise. So if the exercise price is 80 and the spot at expiry is 75, then you will exercise and get a gain of 5 rupees minus the premium, and that will be your net payoff. Now, this is for the option holder. For the option holder, the payoff can be positive or it can be zero. Why? Because if the rate is adverse, I will not exercise, I will let it lapse, and hence the payoff can be zero. It cannot be negative. Similarly, for the option writer, the payoff cannot be positive, which means as an option writer, I don't have a choice. The holder has a choice. So if the holder exercises, I will have to pay. But holder will only exercise if it is advantageous to him, and hence in such a case I will have to pay. So the payoff for an option writer can be negative or it can be zero. However, for an option writer, they will receive the premium, and hence they will add the premium. So let's say there is a payoff. Let's say the rate was exercise price was 80 for a call option, market price is 85, the call option is exercised by the holder, and hence the writer will have to pay 5 rupees net. So there will be a negative 5 payoff, but they would have received a premium, for example, of 6 rupees, in which case the net payoff will be negative 5 and plus 6, that is a positive 1. So over here, net payoff can be positive, negative or 0 for both the option or writer or the holder, but the total payoff can be positive or 0 for the holder, can be negative or 0 for the writer. Now there can be a few other terms as well, like at the money, in the money, out of the money. At the money means an option is likely to be exercised by the holder. At the money is the strike price is equal to the exercise price, and out of the money means the option is unlikely to be exercised. Okay, next you have this payoff chart where on one side you have the stock's price and on the other side you have the profit from an option strategy if it is a call option. Call option is advantageous if the price exceeds, let's say the strike price is 50 and the market price becomes 55, in which case over here there is a $5 gain. But what if the premium is also 5, in which case at prices below 50, well, the option will lapse and hence negative $5 will be your loss. However, once the price is above 50, the option will be exercised, and as it goes higher and higher, the profit keeps on increasing for a long call. For a short call, on the other hand, initially $5 is a profit. If the price is less than 50, the option will not be exercised, then the $5 premium will be my profit. But the moment the price is above, then there will be a loss, and this loss will keep on increasing in case of a short call, for example. Same is the case with put option, where it is the other way around. Put option is favorable if the price is lower. So if I go to see if the price is lower than 50, let's say it is 45 or something, there would be a gain. But if it is above 50, then the option will not be exercised, in which case there is a straight line. Okay, then there are two other concepts of forward commitments and contingent claims. Forward commitments are legally binding to perform some action. It's a commitment, whether there's a gain or loss, it is a commitment that a particular action has to be taken. However, when you look at a contingent claim, like an option, for example, this will be exercised on, or a swap, for example, this can be credit default swap. This will be exercised only if a particular event happens, like for example, if the price goes above 80, only then will the call option be exercised, or if the price goes below 50, only then will the option be exercised, or if there's a default by the issuer, only then will the credit default swap be exercised. And hence these are contingent claims that depend on a particular event. Like options, if it comes in an MCQ, options and even credit default swap are usually contingent claim contracts, whereas forwards and futures, for example, are forward commitment contracts. Okay, next you will go into this reading where you discuss about the benefits, risks and other things regarding derivatives. First is the core advantages of derivatives. First is the ability to transfer risk or change allocation. Like for example, over here you might be a manufacturer who is like a sugarcane producer. Now sugar producer, you need sugarcane after 6 months, you don't know what the price of sugarcane would be, so you can enter into a forward purchase of sugarcane so that you can kind of be rest assured of what the purchase price would be. So you can kind of manage the risk. Very importantly, you can be a portfolio manager who kind of can enter into certain contracts in order to reduce the risk. If you think there is a lot of uncertainty, you can enter into contract to kind of reduce the risk. Or if you are a borrower who has borrowed floating rate, but you think the market is going to be very volatile, you can enter into a fixed for floating swap and again kind of manage, transfer or reduce the risk. So that is one of the core advantages of a derivative. Second is information discovery. Like it can help you in finding what is the estimated volatility possible in case of options, or the prices in case of a future, or even interest rates in case of certain derivative contracts. Third is operational advantages. The biggest use of a derivative over here is it is very easy to kind of take a sell or a short position in case of a derivative, as opposed to the cash market where you have to do the borrowing, enter into stock lending mechanism. It is very difficult. Here entering into a short or a sell position is fairly easy. The lower transaction cost which are there, because let's say usually the brokerage etc. on a derivative is much lower than what is there in the cash market, and it gives you a lot greater leverage. Like for example, if you have only 100 rupees, if you have to go to the cash market, you can just kind of take a share worth 100 rupees. However, in case of an option or a futures market, you just have to pay the premium or margin which is worth 100 rupees. Okay, on 100 rupees, let's say if 10% was the margin requirement. So at a 10% margin requirement and 100 rupees margin, you can actually take a position of up to 1000, and hence with just 100 rupees you are actually having an exposure of 1000, and hence that exposes you to a much greater leverage. And lastly, you have greater liquidity, which means there are a lot of derivative contracts in which you can buy and sell on both, and hence that gives you a much more higher liquidity. Next is improved market efficiency. Now, because it is relatively less costly to even enter into a short position, this gives me a much more better way to exploit mispricing using derivatives. Because it is easier to take a short position, you can take position in larger quantities because of the leverage, etc., and hence this is a much more better way to kind of get uh, uh, use my derivatives. Now the risks in case of derivatives is, like, leverage is a good thing in terms of it helps you take a better position, but like, leverage is good as long as it works in your favor. However, if the prices go against you, then those higher leverages can bring you down very easily, and hence this is a much more bigger risk. Secondly, when you look at the basis risk, the basis risk over here would be the fact that you may not use the exact same underlying. Like for example, you might have a portfolio of shares. However, rather than taking a futures contract for each of these shares, you might take an index future like a Nifty future or an S&P future. Now the thing is, this underlying is your portfolio of shares, which is not exactly the same as Nifty or S&P 500, and hence there may be slight difference in terms of hedging which can come in terms of derivatives. Further, the dates can also be different. So over here there can be differences in underlying as well as differences in timing or dates. Third is the liquidity risk, where when you look at a futures contract, like if it is a commodity future, you're a producer of grains and you are planning to make those grains and sell it after 3 months. Now you have taken a position, however the rates don't, I mean, the idea is, let's say you are going to sell, let's say, grains worth at 50, but if you are worried that the price might change, let's say the price actually goes up, it goes to 60, 70, 80, as a case maybe, you have sold in the futures contract at 50. Now the problem is, the actual sale in the spot market, there would be a gain which would be offset by the loss in the futures. However, that actual sale will happen after a few months. Futures may mark to market margin you have to give, let's say, on a daily basis, and hence that may pose a liquidity challenge where you might not have enough money to pay the margin on the futures contract in case there is a loss for margin calls, in which case the contract will have to be prematurely cancelled. Fourth is a counterparty credit risk, which is usually less. However, when you look at certain contracts, let us say when you look at forwards, both parties bear. In case of options, the option writer does not have to pay any, the option writer does not bear any risk that the other party cannot pay. They have taken the premium upfront, but the holder will bear that risk, that what if the other party does not pay. So different types of contracts have different types of counterparty risks. And then it's a systemic risk, where it is possible that if there is a sudden collapse, there can be a lot of losses which might result in a systemic risk, like what happened in 2008 global financial crisis, which might result from excess speculation. So these are overall risks and the advantages of derivatives. Next, you have the use of derivatives among issuers and investors. When you look at issuers, these are like corporates who might be using derivatives. Corporate users usually use it for managing risk associated with changes in value of assets. Liabilities, earnings, volatility. Like for example, you might want to hedge your forex collections. Money is going to receive from your debtors. You might want to hedge your forex collections, and you might enter into derivatives market, convert your fixed rate liabilities into floating, or vice versa by entering into swaps, or even commodity or inventory price management, in case you are using a fair value model to recognize the value of, let us say, these assets or inventory. Now for that, you also have hedge accounting techniques, like you will have something like a fair value hedge, which is taken to protect the fair value of an asset. Like the accounting for that will be that in case, let us say, there is the fair value of the asset that changes, the gain or loss goes to the P&L. The gain or loss on the hedge will also go to the P&L. If these items are going in other comprehensive income, the gain or loss will also go in the other comprehensive income. There are certain exceptions, but largely for corporates, for hedge accounting ke liye, you can apply cash flow hedge, fair value hedge, or net investment hedge. Like cash flow hedge is like the hedge for protecting the cash flows. Fair value hedge is the hedge for protecting the balance sheet values. And if you have a foreign subsidiary or branch, and if you want to protect that, sorry, there was some issue. So if you have a foreign operation or a foreign branch and you want to kind of protect that, that is called as the hedge of a net investment in a foreign operation. Okay. Next, for investors, like a portfolio manager, you can use it for modifying, increasing the risk. Like you can buy or sell the index future. You can kind of manage the exposure to commodities, etc. So it's a very, very generic heading. Now the next reading focuses on the general principle of what do you mean by arbitrage, what do you mean by replication, and how that can be used for taking the base for pricing the derivative contracts. So first of all, there is something called as arbitrage. Arbitrage refers to a situation where you make a profit without bearing any risk and without making any specific investment. Like you can take a buy position on one side and you can take a sell or a short position on the other side, and if there's a profit without bearing any risk, that is called as an arbitrage situation. So over here, the derivatives are based on something called as no arbitrage price, that is the law of one price, and you will buy one asset at one time, simultaneously sell something else at the other time to make a riskless profit, that is called as arbitrage. Now there are various derivations, we are not going to do that right now, we are just focusing on a quick revision or a review where you can say that the no arbitrage price, if you want to find a theoretical forward or a future price, that is the spot price into 1 plus R for the respective time period. So this is like the cost of carry, where you take the future price is the spot price into 1 plus R raised to T for a regular contract, and if it is a continuously compounded contract, then future price is equal to spot into E raised to R T. This is using continuous compounding that you might even do in quants. Now this is a forward price. Like if let's say the spot price today is 100 and let's say the rate of interest is 10%, then theoretically 1 year later the price should be 100 plus 10%, that is 110. Because if it is not 110, that is if it is more than 110 or less than 110, you can use arbitrage to kind of exploit. Like for example, if your futures price which is available is let's say 120 or 115, 115, that is higher, in which case you would say that it makes sense to sell in the futures market. So your strategy should be to sell in the futures market at 115 and invest today, or let's say buy the share today at, for example, 100. So even if you don't have money, you can borrow the money, buy the share at 100 rupees. That will be, let us say your borrowing will become 100 plus 10, that is 110 after 1 year, and since you have entered into a futures or a forward contract to sell at 115, you can sell this share, get 115, pay off your loan including interest, and still make a 5 rupee riskless profit. So over here, if your actual futures price is greater than the theoretical price, you can actually sell the futures and buy the share in the spot market. Or the other way around, if let's say the futures price is 105, that means it is cheaper to buy the share in the futures market. So your strategy should be to buy the forward or futures at 105, in which case you will take the opposite, that is sell position. Arbitrage, you are taking the opposite or sell position in spot market. So you will sell at 100, the money that you will get, you will deposit, let's say earn 10% and hence become 110 after 1 year. However, that sell position has to be closed by buying. If you buy after 1 year at 105, that means your position is closed. But to buy at 105, well, your deposit will mature, you can use at 105 and still make a 5 rupee gain. Now what arbitrage will do is it will put pressures on the futures price. Like in the first case, more and more people will sell at 115. Demand supply teaches you that if there are more and more people selling at 115, the price will keep on coming down till it reaches 110. Or in the second case, more and more people keep on buying at 105, and demand supply teaches you that as your demand increases, the price will increase and go up to 110, and hence this is called as the no arbitrage price or law of one price, where your future price is equal to the spot price into 1 plus R raised to T, which is your time period involved. Now this is what we have discussed in terms of strategy. If your actual futures 115 is greater than the theoretical futures at 110, you will sell in the futures market, buy the spot by borrowing today. And if your actual futures, that is 105, is less than the theoretical, let us say 110, you will then buy because it is cheaper, in which case you will sell in the spot market and invest today. Above actions will move the actual forward price to the no arbitrage price, as we have discussed. Now another thing over here is something called as replication. Like in no arbitrage, in arbitrage price, you are buying the asset at one of the markets, selling it in the other market. In case of replication, which is kind of a similar concept, where you are creating a portfolio which has a similar payoff. So if there are two portfolios, both of them have similar payoffs, they should carry similar values. Portfolio with cash market transactions that have the same payoff as derivative for the future values of the underlying, in which case payoff of the cash portfolio minus the forward payoff should be 0, because if these portfolios are same, then their value should be same. Again, there is some bit of discussion and derivation. Ultimately, the formula is the same. Either you look at the no arbitrage, which I believe is the easier way, or you look at replication, in which case ultimately if you go to see, you will have these values, which is your future price is equal to the spot price into 1 plus RF. So either you use replication or no arbitrage. I prefer no arbitrage. Ultimately, this is your formula. Now, this is a very simple contract where, for example, there is nothing else other than, let us say, the time value adjustment. But especially in commodity contracts, there can be storage cost, in which case, if you are entering into a position to buy the commodity in the spot market, well, you have to store the commodity, and then storage costs will also come. Or there may be certain assets like shares, etc., which can give dividends, or you can enter into a used car contract, a forward contract, where during 1 year you can use the car and get some benefit. That is called as convenience yield. So convenience yield is like benefits, whereas storage cost is like a cost. So basically, in case there is pricing of a forward contract with, let us say, some storage cost or with some benefits or convenience yield, then what will be the working? Well, your formula will slightly be changed, where you will say that your forward price will have to compensate for the spot price today plus the storage cost into 1 plus RF, or if it is benefit, it will be your forward price will be your spot price minus the benefit. Because, sir, why add the storage cost? Because the spot holder will have to incur the storage cost for that period, but the future holder will not, and hence the value will be higher. And why reduce the benefit? Because the spot holder will get the benefit, but the futures holder will not, and hence you will reduce the benefit. And if both of them come, it will be the spot plus the storage minus the benefit into 1 plus RF. In case it's a regular contract and it is continuous compounding, the formulas will be slightly different. So over here, if there is only storage, you will have S plus the present value of storage cost into 1 plus RF. If it is only convenience yield, S minus the present value of benefits into 1 plus RF. And if it is both, basically you will add the storage cost, subtract the benefits, and that's about it. If it is continuous compounding, then over here e raised to R that you do, instead of R, you will have R plus C into T, and here e raised to R minus B into T that you will do. And if it is both R plus C minus B, basically, long story short, you will add the cost because the spot holder will pay, forward holder will not. So that will increase the forward price, reduce the benefit because the spot holder will get those cash inflows, the forward holder will not, and hence they will be paying relatively less. And hence this will be your adjusted prices if you were to consider the storage as well as convenience yield as well. Now, when you look at the foreign currency contracts, it is discussed a bit more in economics, or if you look at exchange rate parity theories. So you will have the expected forward price upon the spot price. If the rate is given, for example, in rupee per dollar, rupee is the price currency, dollar is the base currency. So this is 1 plus, let's say, the interest rate in rupees, that is the price currency, upon 1 plus the interest rate in dollar, which is the base currency. Here you don't just take one interest, because in currencies there are two currencies, they can have two different rates, and hence you will have to take both of them. So if I want to find a forward exchange rate, it will be the spot exchange rate, I'll take S on the other side, into 1 plus interest of the price currency upon 1 plus interest of the base currency. So this kind of takes care of your arbitrage and replication and the replication. Next three readings, in first of them there will be forward, next there will be, I think, futures, next there will be swaps, and I think options. So these 3-4 readings we will kind of discuss one by one. So here there is this concept of price and value. What is the price of a forward contract? Like, for example, if I agree to enter into a forward buy at the rate rupees 80 per dollar, then 80 is my price of the forward contract, will remain unchanged throughout the period of the forward contract. However, as the rates change, then the value of your forward contract will also change. Now, initially, usually the value of a forward contract is like nil. The way it is priced, like the no arbitrage price, it will be nil. However, since this rate is remaining 80, however, it is now expected that a few months later, your rate will become 85. In which case, the difference between 85 and 80, that is 5 rupees, is the value of the forward contract, which will be after, let us say, let's say 5 months, 4 months, in which case you will find the present value, but the value of a forward contract can possibly change. If you are long the forward, you will be gaining if the value of the underlying asset increases. If you are short, then you will be gaining if the value of the underlying asset kind of decreases. So over here, the no arbitrage price, the formula is still the same. It is also sometimes called as the cost of carry model. The value of a forward contract value in general, initially this is the spot price minus the present value of the future price. However, as time passes, let us say it's a 6-month contract, 2 months have gone, 4 months are remaining. Your spot price after 2 months will be something else. So that is ST, that is the price after 2 months, minus the 80 rupees, which is after 4 months. 80 rupees ka present value, which is, let us say, after 4 months. and that will give you, so over here, let us say the value of the asset now becomes 85. However, this is, you have agreed to buy it 80, but this 80 is after uh, let us say 4 months, so into 4 by 12, and in a way that will give you the value of the forward contract. Now, if when you reach expiry, there is no further time value adjustment. This is a spot at expiry. Let us say the spot becomes 87 minus the forward rate, that is 80, and then 7 rupees will be your value. Remember, when you look at the price, this price is expected to remain constant. However, the value of a forward contract, that is, the value is like the net settlement amount, this will keep on changing. Special case, in case there is kind of cost and benefit, as we discussed. In this case, your value will be spot plus the present value of storage minus the present value of benefits minus the present value of the forward. So after considering the storage as for the remaining 4 months, or after considering the benefits of the remaining 4 months, adjusting that, you will take the difference, and that will give you, let us say, the value of the contract. Okay. Second is in case of interest forward contracts, and describe the uses of forward rates. Now, this is something that you will do in fixed income as well, where you will try to find forward rates, something like 2y, 1y, that is 2 years from now. If I want to take a forward for 1 year, then what is the rate? Or let's say 1y, 1y, that is 1 year from now. If I want to take a borrowing for 1 year, then what is the rate? It is like saying, if a 2-year fixed deposit is costing you 12% per annum, and a 1-year fixed deposit is costing you, for example, 10% per annum, then what is the rate for the second year? This is like 1y, 1y contract. So 1 year later, for a period of 1 year, what is the rate? That is 1y, 1y contract. In which case, the theory is, you will say that the value, no arbitrage price, 2 years later will be the same. So if you invest $1 for a period of 2 years at the rate 12%, that should fetch you the same as 0.1 into 1 plus, let's say, R2. And if you sit and solve, this will come to, let's say, R2 of around 14.04%, which means this is a forward rate. So sometimes you can implied forward rates, you can calculate by doing these workings. So over here we have taken this example, and this is a formula. Okay, so this is regarding implied forward rates, which can be used as a base for setting up something called as a forward rate agreement, or also called as FRA. These are rates at a future date. If someone wants to borrow after 1 year for a period of 1 year, then probably 14.04% is a rate which the bank will quote in the forward rate agreement. Okay, now when you look at a forward rate agreement, the fixed payer to pay the fixed rate to the floating pair. Acha, this is like an interest rate swap, I believe. In case of an interest rate swap, it is like a series of forward rate agreements where a fixed rate pair is going to pay the fixed rate. Let us say this is 10%, and the floating rate pair will pay the MRR, the market reference rate. Let us say this is a secured overnight financing rate, SOFR, and the payments in this case, let us say, will be over here net settled. Forward rate agreement to be settled on a forward date on a present value basis. Like for example, if the secured overnight funding rate is 8%, in which case you will have 10% minus 8%, that is equal to 2%. So if the notional principal is 100, that is a payment of 2. However, ideally the payment of 2 is going to happen after 1 year, because this is interest accrues over time, but you want to settle it right now, then you will have to settle it on a present value basis, and usually the discount rate will be the market reference rate. Say 3 months later, say 3 months, 6 months FRA would be settled at the 3rd month, with MRR at 3 months taken as a discount factor for 6 month period. This is the specific case. In our example, 2 is the net settlement value. Whatever is the MRR, let's say 8% will be taken as a base, and you take the present value of 2 rupees. Let's say if this was a 1 year settlement for a period of 1 year at 1.08 discount rating rate. So net settlement would be 6 month MRR rate minus forward rate. In our case, this was, for example, 8 minus 10, that is 2% into notional principal. This is half yearly, so they have taken 6 by 12 into 1 plus the 6 month MRR into 6 by 12 if this was half yearly. Okay, so a forward rate can be used for managing volatility, is usually forming a base for the interest rate swaps as well. A basic example is discussed over here, that this is your fixed rate and the reference rate is 1.5%. Your net settlement will be 1.5. I mean, you have agreed to borrow at 1.3, but the rate becomes 1.5, so 0.2% is your gain into $10 lakh into 6 by 12, but this is going to settle after 3 months, so divided by 1.1 plus 0.015 into 3 by 12 or 6 by 12 as the case may be, and this will give you your answer. Okay, next you will have futures contract. Now in case of futures contract, the beauty of a futures contract is it is priced daily. Like when you took a futures at, let's say 80, you agreed to buy at 80 and the rate becomes 81, there is a 1 rupee gain. That 1 rupee gain will be handed over to you and the contract is deemed to be settled and the new contract will be entered at 81. The rate next day becomes 81.5, then another 0.5 will be given to you. The contract is deemed to be settled and the new contract is entered at 81.5, and hence in case of a futures contract, what will happen is the price will be kind of like a forward contract. The price of 80 remains the same because there is no mark to market settlement. But in case of a futures contract, the price of 80, 81, etc. keeps on changing in such a way that after settlement the value is then 0, because at the end of the day, if the rate moves from 80 to 81, 1 rupee is given and a new contract is entered at 81 and that contract has a 0 value, and hence then it goes from 81 to 81.5, another 0.5 is given to you, the contract is settled, a new contract is entered at 81.5 and hence that has a 0 value at initially. So basically for a futures contract, the price as well as the value keeps on changing. There will be a mark to market settlement daily in case of futures, will not be there in case of forward. Forward price remains the same, value keeps on changing as the rate changes. Okay, so that is an example. When you look at interest rate futures, there's an interesting thing regarding interest rate futures, that interest rate is a rate, but you cannot, futures need to be quoted, the price needs to be quoted. Like you can't buy and sell an interest rate, but you can buy and sell a bond, and as a result interest rate futures are quoted in terms of bond prices, and hence this is 100 minus whatever is the MRR. It's like a equivalent notional zero coupon bond, where this is a price of an interest rate future. This is quoted on a price basis and this is 100 minus MRR. So if your MRR for example is 5%, this is 100 minus 5, 95 will be the price at which you may buy or sell the interest rate future, as a case may be. Again, they are subjected to mark to market daily, and there is something called as the basis point value, which is nothing but the notional principal. Let's say that is $100 million into the period, let's say it is 6 by 12 into, for example, 0.01%, which means if there is a change of 1 basis point, then by how much will be the change in the value of the interest rate future? That is called as the basis point value. X1 by futures and forward price differ. Ideally, they should not differ. They will remain the same, and even if they differ, there is a small difference. The reason for difference is the interest rate. Like in case of forward, you settle, let us say, at reset periods. In futures, you do a daily mark to market settlement. So if your interest rates at initial remain constant, then the prices of forward and future will remain the same. There is daily mark to market settlement, and hence forward versus future, the prices will remain the same if there is constant interest rate or it is uncorrelated, in which case forward and futures are same. However, listen to this carefully. If let us say the interest rate increases as your asset price increases, like if your asset price increases from 100 to 110, by the way, at that point interest rate also increases from 10% to, let us say, 10.5%. If you are long the futures contract, this movement from 100 to 110, there will be a 10 rupees gain. In the futures market, this 10 rupees will be deposited now at 10.5%, and hence that will result in a higher income. So usually when the asset prices increase, there will be a gain and you can deposit the gain at a higher rate, and hence futures will be more advantageous. On the other hand, if the asset prices fall, it goes from 100 to 90, that means there's a 10 rupee loss, in which case you'll have to pay that loss, but that loss you will borrow at a relatively lower rate. So if this is 10%, falls to 9.5%, in which case the borrowing rate will be lower, and hence futures, long story short, for your revision perspective, if the interest rates and futures price are positively correlated, in which case futures are more attractive than forward. Why? Because if the price increases and interest rate also increases, you can deposit the gain at a higher rate. If the price falls and the deposit borrowing rate also falls, in which case you can borrow the margin call at a lower rate, and hence it is more favorable. The other way around, they are negatively correlated, then futures are less attractive than the forwards, because the price will increase of futures, there is a gain, but you can reinvest it at a lower rate. The price will fall, but you'll have to borrow at a higher rate, in which case futures become adverse as compared to the forward. So largely the futures and forward pricing should be the same, except for interest rate, it can come in an MCQ, then this is the understanding that you will deploy. The thing in futures is the gains above initial margins can be withdrawn and losses below maintenance margins require margin call, and that is not there in case of a forward, and that kind of brings to the forefront the differences that may arise between a future and a forward. Special case in case of FRA pricing or IRF pricing. When you look at futures, the gain or loss is constant. There is no convexity bias. However, in case of a FRA, remember we discussed in the earlier session, I mean the earlier reading, that what happens is you will, when you go to settle the FRA, you will take the difference between 1.5% and 1.3% into 10 lakhs. However, this difference is actually going to become due after 6 months, and hence you want to find it the present value today, you discount it by today's MRR. Now the thing is, this is a little complex. It is linked to the concept of convexity. This in any case is complex when it comes to fixed income. Similar concept over here. Like for example, if there's a 1 million interest rate future which is now priced at 97.5, so MRR is 2.5%. Now if you are kind of a borrower, you are buying at 2.5% and the rate goes up, let's say to 2.51%, in which case you are gaining because you have bought at 2.5 and the rate becomes 2.51, so there will be a gain. But if the rate becomes 2.49, now you are stuck with buying at 2.5 when the rate is 2.49, so you will lose. Now the thing is, because of that divider being different, like the working will be the same, so it's 2.51% minus 2.5%, let us say, into a $1 million principal into 6 by 12. So this will be the same. There's no difference. So if I go to see, this will probably be around $50. So, but this $50, if the rate in the market is 2.51, will be divided by 1 plus 0.0251 into 6 by 12. But if the, or on the contrary, if the rate is, for example, 2.49, this will be divided by 1 plus 0.0249 into 6 by 12. And hence the values will be slightly different, and it will be different to such an extent that if the rates are going to go up, like if the market rate of reference rate goes up, like it goes up from 2 to 2.51%, then your settlement value will be lower. Why? Because you are now discounting at 2.51%, as compared to when the rates fall, it becomes 2.49%. Then your payment with a lower MRR, the settlement value will be higher. As you can see over here, if it is 2.51%, your settlement value is 49.38. I mean, I think I said the other way around, just that over here, if I go to see, this comes to, let's say, 49.3803, which, and this is 49.3852. So this will give you higher value at a lower MRR. Because the MRR is lower, the discount rate is lower, your value is higher. You are getting, let us say, 49.38 value over here, and at a higher MRR, you will end up paying or getting lesser, as a case. Maybe this is like in a bond, there is convexity. There is a similar convexity adjustment over here, which is to be looked at. This is called as convexity bias. Have a broad understanding and kind of proceed on this. Okay, then is valuation of interest rates and other swaps. Interest rate swaps is nothing but a series of FRA. So when I look at an interest rate swap, let us say for a 4, it's a 2-year, 6 monthly. That means there are half yearly, in 1 year 2, in 2 years 4 arrangements. Now the problem over here is, this is like a FRA where there's a fixed rate which is clearly predetermined, and then you will compare it with the market reference rate at each of these reset periods. Initially you will know the settlement value for the first period. There will be 3 unknown factors, and the settlement will be net. Like for example, the fixed rate is, you are a fixed rate buyer, you have agreed to pay a fixed rate of let's say 5%, and the rate becomes 6%, in which case you will get a net 1% into 6 by 12, but you don't know what the rate will be 6 months later. Let's say the rate becomes 7%, then 7 minus 5, 2% you will get. Now later it might become 4%, in which case 1% you might have to pay. So this is like a interest rate swap is like a series of forward rate agreements. It's a series of FRAs. One party pays fixed, another party floating, and settlement happens on a net basis. Settlement happens as a start of each reset period on a present value basis. The discount factor over here will be the market reference rate for that respective period. For IRS with quarterly interest, 4 payments, out of which 1 known, 3 unknown, that is fine. So either ways, you will take present value basis. The first settlement will be at the start of first quarter, second settlement start of second quarter, and so on. Now, it appears that IRS is exactly similar to FRA, but the thing is, in case of IRS, the fixed rate is constant. if you enter into 4 different forward agreements, it is possible that you can enter into 4 different forward rates, but here the fixed rate is constant. So forward rates would be like the fixed rate. Each forward rate agreement in IRS may not be a zero cost forward. So it is like you are saying that there are 4 FRAs, and generally in case of a forward we say initial value is 0 if it is a pure forward, but if it is 4 different forwards, it is possible that in 1 or 2 of them there is a positive value, in 1 or 2 of them it's a negative value. Net the overall value might be 0, will be 0. However, when you look at the individual FRAs, the value may or may not be negative. There may be some positive, some negative. Some FRAs may have a positive, some FRAs may have negative, and initially the total value is nil. There is something called as a par value swap rate. This is a swap fixed rate giving a 0 value initially. Like if, I mean, you are expecting 4 different market reference rates. It may be 4% for the first 6 months, then 5% for the next 6 months, then 7% for the next 6 months, then 8% for the next 6 months. You are expecting 4 different market reference rates. If instead of these 4 different rates there was a single rate in each of these 4 periods, then what would that be? That would be called as the swap par rate or the swap fixed rate, which is calculated as, let us say, over here 4, 5, 7, 8 divided by the respective spot rate equals, let's say you call this as x, you keep this as x, everything else you substitute, and that will give you your fixed rate that should initially be kept for the forward rate agreement, and that will ensure that initially the value is 0. So pricing the fixed rate swap, well, initially the fixed rate swap will be priced using the par spot rate, as we said, where if these were the respective rates and let's say you were given the spot rates for each of these period, you will try to find these values and keep the fixed rate or the par swap rate as x. Whatever is that x, if you find, that will give you the par swap rate. Initially the swap value will be 0, the present value of the fixed rate payments will equal to the present value of floating rate payments. So you are saying that on both sides, initially for the no arbitrage price to apply, and derivatives are priced using the no arbitrage principle, in which case the present value of floating rate payments, that is MRR upon 1 plus S1, MRR2 upon 1 plus S2 raised to 2 and so on, will be equal to the present value of the fixed rate payments, that is F1 upon 1 plus S1 raised to 1, F2 into 1 plus S2 raised to 2, where F will be constant. It is a par swap rate. So as given S1, S2, you can find par expected. Okay, conceptually this can come from an MCQ perspective. If you are expecting the market, you have entered into the swap, let's say your par swap rate, let us say, comes to around 6%. Let us say for simplicity it comes to around 6%. Sometime it was 4 and 5, sometimes it was 7 and 8. On an average it comes to around 6%. Now if later you are expecting your market reference rates to be more than 5, 7, 8, you are expecting them to be even more, in which case a fixed rate buyer or payer will be better off because they are agreeing to pay at that average 6% when the rate is higher. But if the later MRR is expected to be lower, then the fixed rate payer is ultimately end up going to pay more. So what we are trying to say is, if you are expected that there will be an increase in MRR over what is currently projected, then fixed rate position will have a positive value. But if you are expecting MRR to fall, then fixed rate position will have a lower value. So basically, logically, intuitively, you can say that initially if you have to set up a rate, you can set up a rate using 4, 5, 7, 8 and respective spot rates. Let's say it comes to around 6% on an average, and if you are expecting later the rates to be higher than what was projected, then the fixed rate payer will be in a better off position. If the rates will be lower, then the fixed rate payer will be in a poorer position. The value of fixed rate position is the present value of the expected floating payments. Earlier we were thinking, let's say after the first payment is done, that floating payments will be 5, 7, 8. Now you think floating payments will be higher. Okay, minus the present value of future fixed rate payment. So over here, if you kind of do it with numbers, it is a little more understandable. Having said that, in derivatives, at least over here, they don't ask you so much technicalities. It's more of an introductory section. So next you go into options, pricing and valuation of options. We are just going to over here discussing options. There is something called as moneyness. We have discussed earlier. Moneyness would be option being at the money, where the strike price or the exercise price is equal to the spot today, or it is in the money, where the option is likely to be exercised. Like for a call option, the spot price is greater than the exercise price, it is in the money. Or for a put option, the spot price is less than the exercise price, it is in the money. On the other hand, out of the money means the option is unlikely to be exercised, in which case for a put option, the spot price is greater, then I will not exercise. In a call option, the spot price is less than the exercise price, I will not exercise. So this is in the money, out of the money, at the money. Okay, then you look at option valuation. When you look at option value is made up of two components. One is something called as intrinsic value or the exercise value, which means if let's say the spot for a call option, for example, if your spot is 70 and your exercise price is 50, which means there is an exercise value or an intrinsic value of 20 rupees. However, this is going to happen at a later point of time, and hence there will be some time value involved as well. So an options value will have both an intrinsic value as well as the time value. Before expiry, the option value is a combination of both. As it comes closer and closer to the expiry, the option is only likely to have more of exercise value or intrinsic value, and the time value keeps on getting lower and lower. So when you look at exercise value or intrinsic value, call option current spot minus exercise price, like 70 minus 50. Put option exercise price minus spot price, it cannot be negative. Time value due to the time between the trade date and the exercise date, and option value, that is premium, will be a sum total of both of them. When you go to level 2, you will do a lot of option valuation like Black-Scholes, etc. Okay, contrast the use of arbitrage, replication on contingent claims. Basically, there's a lot of theory on this particular section, but largely what you should try to remember is intuitively that if you look at the lower and upper bounds for options, and they've mentioned that even if you kind of understand and remember this, that is sufficient. Like for a call option, what can be the minimum value? Well, minimum value for a holder will be 0, or the difference between the spot price minus the present value of the exercise price at today's value. That considers both the options intrinsic value as well as time value. So when I look at S0 and SX, purely that is intrinsic value, but I'm also looking at the time value. So considering both of them, that will be your maximum value today. And when it comes to that will be the minimum value today. When it comes to the maximum value, I would say that if the spot at expiry becomes 0, or over here, if let us say you have a right to buy, if your maximum value is whatever is the spot at expiry, that is your maximum value. If your exercise price is 0, over here you're saying if your exercise price is almost 0, then whatever is the spot at expiry, that is your benefit, that is a maximum, you can't get more than that. Further, in case of a European put option has a right to sell, again the minimum value, it cannot go less than 0, so it is 0, or well, it is XP minus S, but XP over here is at a future date, so you take the present value. So over here the present value of XP minus S, that will be your value, or 0. Maximum, if your spot is 0, then maximum is your gain is your exercise price. If your spot is 0, your maximum gain is the exercise price. Okay. Next is, what are the fundamental factors determining option price? You will use this more in detail when you go to level 2, where you will discuss about certain concepts like option Greeks. But at this stage, what are the factors that will affect the options price? First is the spot price. As the spot price changes, the options value will change. Second is the exercise price, whether the exercise price is higher or lower, as the case may be. Third is the volatility. Fourth is the risk-free rate. Fifth is the time to expiry. There are a lot of factors which will affect, and over here we have tried to summarize the impact of these important factors, which will definitely be helpful for your MCQ working. Like, what will happen if there is an increase in the price of the underlying asset? Now, if there is a call option, if there is a price increase in the spot price of the underlying asset, exercise price remaining constant, at let's say 80 rupees is your exercise price and the spot price goes up 82, 83, 84, your call option becomes more and more valuable. The value of the call option will increase, but put option will become less and less valuable. Because put option, you want the price to decrease. If the price increases, put option becomes less and less valuable. So if you look, increase will result in an increase in the value of the call option, but decrease in the value of the put option. Now, exercise price. Now, call option will prefer a lower exercise price. If the exercise price is lower, that will result in a higher value. Exercise price is higher, it is costly to exercise, it will result in a lower value. Put option is the other way around. Exercise price is higher, is more valuable. Exercise price is lower, you can sell it at a lower price, less valuable. So when you look at exercise price, if there's an increase in exercise price, I would say call option value will decrease, but put option value will increase because you're getting a chance to sell at a higher price. Risk-free rate, this is kind of the discounting value. Like when you look at these values over here, if your discounting rate increases, in case of a call option, it is spot minus the present value of exercise price, and if your discounting rate or your risk-free rate, for example, increases, then this present value of exercise price will actually fall, and thereby spot remaining the same, if the present value of exercise price falls, your call option value will increase. So as you can see, risk-free rate increases, your value of the option also increases. But when I look at this value over here, present value of exercise price minus spot. So if the risk-free rate increases, the present value of exercise price falls. Present value, if the rate is higher, discounting factor is higher, the present value is falling, and hence for a put option, this will be a decrease. Volatility, well, remember, this is uncertainty. More the volatility, whether it is a call option or a put option, both of their values will increase. And time to expiration, usually as time, it's like an insurance contract. So if your time reduces, value also reduces. If your time increases, value also increases. So in general, we will say there is an increase, there is an exception, but in general, there is an increase. Cost of holding an underlying asset. This is like a storage cost. For example, if that cost becomes more and more costly, then in case of a call option, the value will increase because you are giving a right to buy it to someone and you are incurring that cost as a spot holder, you will charge a higher value. And this will be decreased. Benefits of holding the asset, it is exactly the other way around, because in case of a call option, the spot holder who is holding the asset will get the benefits, and with a higher income, the holders of the call option will be ready to pay less. And in a put option, I am already holding the asset, which there is a right to sell. If I am earning income as well, I can say that this is helpful for me, and hence that will increase the value of the put option. So this is a little taxing, at least a increase, decrease, increase, decrease to remember. But if you kind of get a grasp over this, it is helpful because this is classic MCQ material. Okay, next we go into the last two readings. First you have the call put parity and then the binomial option valuation. So over here we are discussing using call put parity theory. This is also again based on option replication and no arbitrage approach. That is, if there are two positions which will result in the same value after, let us say, 1 year, if the values are going to be same, the payoffs are going to be same after 1 year, then their value today should be the same. So based on that, for call put parity, there are two positions that are created. One is called as a fiduciary call position, where you buy the call option and go long on a let us say bond, and there is a protective put position, which is where you buy the put option and go long the share. So over here, these are the two positions where there is a fiduciary call where you go long the call, and there is a riskless bond, and there is a protective put where you go long the share and there is a put. Now the beauty of these two positions is, if the exercise prices are same, then no matter what, at any levels after 1 year, these values will exactly be the same. And the point is, if they are exactly same after 1 year, then that means they have to be same today as well. Now before we go to these derivations, if we kind of just take an example where if let us say there is a call and a put option of a share like Reliance with an exercise price of 100 and time to expiry is 1 year, the positions after 1 year under different spots at expiry would be, let us say, if your spot at expiry becomes 50, that is, it is less than 100, in which case you are holding a fiduciary call, that is a right to buy at 100, you will let it lapse and a deposit will mature and become 100. So which means you will have a cash balance of 100 after 1 year. Acha, on a protective put, you had a right to sell at 100 and the share is worth 50, you will sell it and get cash worth 100. So both of these positions are having the same values. Or if the spot price is 150, then on the fiduciary call, you have a right to buy at 100, which you will exercise, and hence the deposit will give you 100 rupees. You will use that cash to exercise on exercising of call option and get a share which is worth 150. Protective put, you have a right to sell at 100. When the share is worth 150, you will not exercise, and hence over here in both cases you will get the share worth 150, and hence you can say that C0, that is called today, plus present value of XP, PV of XP, exercise price, that is a fiduciary call position, will equal to the protective put, that is P0 plus S0. So these values will be the same, and as a result, if these values in a way are same, we would say that the position after 1 year is the same, then position today also should be the same. So this equation is called as a call put parity theory. Now over here, what you can do is you can rearrange this, like you can take PV of exercise price on the other side. So that will be C0. C0, that is buying call, can alternatively also be buying put plus buying the share minus you have the present value of exercise price, that is, instead of depositing, borrowing, let us say. So that is like a synthetic. So over here, if you look at the call put parity, the payoff of a fiduciary call will equal to the payoff of the protective put irrespective of spotted expiry. So this is your call put parity, no arbitrage principle. Synthetics can be created, and what is synthetic? You are just kind of rearranging. You are taking spot on one side, call minus payoff, and the exercise price. So you took put on the other side. For put, you are saying C0 plus PV of exercise price minus S0. So over here you will have this. So in a similar way, you can create a synthetic position. So instead of going long the put, alternatively you can go long the call, you can short the share, and you can deposit money, and that will be kind of similar to a put position. So these are synthetic positions. There can, what you studied was call put spot parity. There can also be call put forward parity. Now what do you mean by call put forward parity? In this case, when you are looking at the forward rates, instead of taking spot rates, like the rate is C0 plus PV of exercise price equals P0 plus, now instead of spot rate, you will take the forward rate, but forward rate is at year 1. Okay, so over here forward rate upon 1 plus RF, that is the present value of the forward price, and that's about it. So when you look at the call put forward parity instead of spot rate, remember you looked at this formulated spot rate into 1 plus RF equals the forward rate. Now alternatively, you can take S0 equals the forward rate upon 1 plus RF, that will be a proxy for the spot rate. So over here you can substitute that, and that will give you the call put forward parity. So this is C0 plus the present value of exercise price equals P0 plus the present value of forward price. So instead of S0, we take the present value of the forward rate, and that will be synthetic. Synthetic means it is not exactly spot, something else. So over here present value of forward you are taking, so that is called put forward parity. Now there's some application of options in the context of corporate finance, not really important from an exam perspective, but if it comes in an MCQ, like for example, if you look at equity is like a long call position, which means if let us say the value of the firm is 100 and the value of debt is 40, in which case over here you will pay off the debt and the remaining 60 will go to the equity. However, if the value of the firm is 100 and the debt is 140, in which case you will not, the equity does not have to pay negative 40, I mean because of the limited liability principle, and hence the payoff to equity is 0. It's like a long call position. So equity is similar to a long call, whereas debt is similar to a long risk-free bond along with the short put. So if you are having a bond and you are having a short put option, that is you have given a right to sell to someone, which means if for example over here the debt value is 40 and the value of the firm is only 10, in which case the debt holder will get only 10. They will not get 40, so 30 rupees is like your loss. But if your value of the firm is 100 and your debt value is 40, you are going to get 40, you are not going to get anything beyond that. So it is like a long risk-free bond along with the short put. If you can kind of just remember that, that is kind of sufficient. And then moving on into the last section over here, which is valuation of the options using a one period binomial model. Over here there are various ways in which you can solve. What we will focus on is a method called as the riskless hedge method as well as the risk neutral probabilities method. So as the name goes, over here you are trying to find the value of an option using binomial option valuation. Binomial means the price might take one of the two possibilities after, let us say, a particular year. So over here I don't know if there is an numerical example somewhere. Okay, so if there's an example where the price today is 50, exercise price is 55, the price after 1 year can be either 60 or it can be 42 and the rate is 3%. Then over here you can draw a binomial tree where you can say that the price today, for example, was 50, exercise price is 55, the price after 1 year will be 60, it can also be 42, in which case if let us say these are the possibilities, one of the options in one of the ways in which you can do this valuation is something called as a riskless hedge, which means if you are entering into a portfolio which is a long shares and a short call position. So over here you are entering into a portfolio in such a way, I don't know what the price of the share will be after 1 year. So you kind of try to enter into a hedged portfolio where you can say that the price of the share can either be 60 or 42, I don't know, I want to hedge it. So the hedged portfolio over here is the long shares, let's say X shares, and short one call option. So first is draw the binomial tree. The portfolio, let's say for a call, will be long shares and short call. Put will be slightly different, but let us say we focus on the call. So this is long how many shares? Let us say X shares, and short one call option. So which means initially over here your investment will be X shares and the spot price is 50. So this will be what you will invest minus call option, whatever is the premium, we don't know, minus C0, that is your premium. Now 1 year down the line, if the rate of interest is for example 3% and you are having this long shares, these X shares will now be worth 60. So over here the position will be worth 60X, and the call option we have shorted, which means you have given a right to buy to someone else at 55. The payoff will be a -5. Why? Because, well, you are short the call, the holder will exercise, and hence they are getting a right to buy at 55, something which is worth 60, and hence you will have to pay 5. On the other hand, I'm really sorry. On the other hand, when you look at the second case, you are having shares. How many shares? X shares. Price is 42. However, the option will not be exercised because they are having a right to buy at 55 shares which are worth 42, and hence they will not exercise it. The payoff will be 0. Now the problem is there are these two positions, but the thing is they are hedged, and hence these two values have to be equal. They are hedged. The hedge means no matter what happens, and these are the two possibilities, these values will be equal, which means if you sit and solve, this will be what? 60x minus 5 equals 42x minus 0. Therefore you will take this, maybe 18x on one side equals to 5. Therefore x equals, if I am not wrong, 5 divided by 18. This will give you 0.28. That means for every call option sold, you will go long 0.28 shares. Okay, once you do that, that means you can find a value at any of these positions, that is 42 into 0.28 minus 0, or you can do 60 into 0.28 minus 5, you will get the same answer. So around this will be around 11.76, which means we are sure that after 1 year, no matter what happens, our portfolio is going to give me 11.76, but because it is hedged, the positions are risk free, and hence we can say that the value today will be 11.76 divided by 1.03. Why? Because, well, they are going to give me the risk free rate of return, there is no risk, and hence 11.41 will be the investment today. However, you invested 50x minus C0, which will be equal to 11.41 or 42. Therefore you will say 50x 50 into 0.28 equals minus C0 equals 11.41. So over here this is 50 into 0.28 and 14 minus 11.41 or 42 as a case maybe, so that is 2.58 or 59 as a case maybe, that will be the value of the call option. So basically the steps over here will be to draw a binomial tree. The hedge position will be long X shares for one short call option. Put, if it comes, you can use the call put parity theory, substitute the call, the shares price, the exercise price, and get the value of the put option. Or put is long shares and long put, this is the position. Investment today will be shares purchase, that is 50 into X minus premium of call that you have received, C0. The hedge ratio you can calculate if you want to, C1 minus C0. This is basically you can directly do the working. Institute has not done it, but you can directly do as well, like the C1 minus C0, that is 5 minus 0 upon, this is 60 minus 42. So this is 5 divided by 18. If you do, you get this same 0.28 as a shortcut. You find value of N1 and N2 by substituting X as above. So you found this as 11.76. Either ways you do. However, since the position is hedged, payoff under both possibilities would be the same, and hence both of these will give you the exact same values. So the present value, you will take 11.76 ka present value, which came to around 11.41 or 42 as a case may be, and this will be the investment today. So substitute I0 and X in step 3 to find the missing value of C0. So this is using a approach called as a riskless hedge. So this is just a one period binomial tree. You create a hedge portfolio by buying X shares and selling one call option. A hedge portfolio will mean that the value of year T would remain same. Therefore, we create a position today in such a way that the overall portfolio after year T is the same. Okay, and you can solve. And then is risk neutral probabilities. the CFA Institute has clearly written that the calculation of risk neutral probabilities is not something which is required. Though they have given you a particular formula, my point is even without that formula, you can do it very, very easily. Like over here, if you wanted to find the risk neutral probabilities, typically what I prefer, and this is not what the CFA Institute has given, what I would prefer is you can find the probabilities of up move and down move. Like the spot price today, which is 50, will be the present value of the future price is 60 into P plus 42 into 1 minus P. The value of the share today is the present value of future cash flows, which means if I were to do this and find P, for example, this is 50 into 1.03 comes to 51.5 equals 60P plus 42 minus 42P. So this is equals to what? 42 minus or 42 plus I believe 18P, and hence 51.5 minus 42, this is 9.5 divided by 18 comes to around 0.527 or 0.53. Let us say P is around probability of up move, which is 0.53, then probability of down move will be 1 minus P, that is 0.47. This is a shortcut. Institute uses a slightly different formula, something like this, where you can do the working and get almost the similar probabilities. But let us say over here, this is the probability of up move, this is the probability of down move. Now value of a call option will also be the present value of future payoffs. Now the future payoff in the first case is 5, which has a 0.53 chance. The present value is 0, which has a 0.47 chance, which means 5 into 0.53 will come to what? 2.65 approximately, which is almost similar to the same number that you would have gotten under the earlier option method as well. So it's around 2.6. So what we try to do is we try to find a probability of up move and down move. Institute has clearly mentioned it, even if you see the Schweitzer notes, that the calculation of the probabilities of up move and down move is beyond the scope, and hence you don't need to bother about that. But if you do, then you can do this, find, I mean, because it is just an MCQ, find the probability of up move and down move by taking spot prices, the present value of future cash flows. Use that for the call option prices and you will get the call option value. Though what the CFA Institute does is it will take the probability of up move as P is equal to 1 plus RF, maybe your RF is 0.03 minus D upon 1 plus or U minus D, where U is up move factor, which is, let's say, by how much is the price going up? We don't know. It is going up from 50 to 60, that is 60 minus 50 upon 50, that is I think 20%. So this is 1.2 minus, if I take the inverse of this, if I am not wrong, this is 0.89 something, so this is minus 0.89. So if I do this, if I take the inverse, down move probability is 1 minus up move probability, down factor is 1 upon up move factor. So this is 1.03 minus 0.89 comes to 0.14 upon 1.2 minus 0.89 comes to 0.31. So if I do 0.14 upon 0.31, let's say it comes to what? 1.2 minus 0.89. This is 0.31, 0.14 upon 0.31. This comes to around a slightly different number, I believe. But this is annual into m by 12. So this is a formula that they are using for calculation of probabilities. I think maybe in some of the calculations I have kind of moved around a little, so maybe it is not coming accurately, but by and large this should be the working which should give you the correct probabilities. I think that should take care of your section of derivatives, and I hope this quick revision, pardon me if you felt this to be a little quick, because the idea was not doing a 5 and a 6 hour derivative session for something. I wanted to kind of touch base the entire surface. I hope that has been clear for you, and I'll wish you all the very best. Again, if you have liked this content, please make sure that you subscribe and you like the video, share it with your friends, means a lot to us. And in case you need any other topics, any other specific videos, maybe detailed, maybe with sums, please put it in the comments box so that we can kind of take that into consideration and put that across as well. Okay, so that should be it. I'll see you soon. Till then, study well, good luck, goodbye, and take care.